Good morning traders and welcome to a brand new video. I've got a lot of requests regarding market structure and liquidity. More importantly liquidity. I've got a lot of people asking about liquidity, how to identify it, and then I decided I'm going to mix it with market structure because I do believe that those two are probably the two most important aspects regarding analysis, and when you open your chart you need to identify those elements. So this is the first video. In the next video I'm going to look at the smart money concept tools that I use. So that will tie in with what we discuss in here. So you might have some questions. We're not going to discuss everything today, but I do believe it will give you a better understanding of structure and liquidity. So before we carry on, please subscribe, like, and put on that notification bell. Stay till the end because obviously the good stuff comes at the end. Okay, so first of all, market structure and liquidity. A few things that we need to just clarify and put out there is that we know, well, I assume that most of you know that a bullish market structure is composed of a structure that looks like this, where we have price creating higher highs, higher high, higher high, and a higher high, followed by higher lows. So this is a low, this low is higher than the previous one, and then this low is again higher than the previous one. So that is our bullish market structure. So that's relatively obvious for most of us, but just for completeness sake, for new beginners as well. Then we have bearish market structure, where we move towards the downside, where price is creating lower lows and lower highs. In this case, we can see price created a low, followed by a lower low. You can see that this low is lower than the previous one. A new low is also lower than the previous one, followed by the high lower, and then followed by the lows that also are stepping down. Almost like a ladder moving towards the downside, making lower steps and lower highs. Then the last one that we know is ranging market, where price is just moving sideways. Just moving sideways. It's not making higher highs or higher lows. It's moving sideways. So this can be a very good range to be trading within, and I often like trading this range, especially GU. That's a tip, because GU has big ranges usually, and there's a lot that you can take in this range. But there's different ways to trade each of these market conditions. So just for completeness sake, we'll just type here bullish so that you know, that you can make notes. And this is our ranging market, and then we have obviously our bearish market. So bullish, ranging, and bearish, and this is evident and on all time frames everywhere you can see it. There's no specific rule to how big it should be, or how many impulses. An impulse, this would be an impulse, this move up impulse, this move up impulse, this move up is an impulse. So there's no set amount of impulses that it should have. This, I know Elliott wave theory has different views on it and so on. I'm not concerned about Elliott wave, and if you don't know what I'm talking about, don't worry. I'm also not sure of what Elliott wave is anyway, so don't worry about it. Let's have a look at some examples. This is the 50-minute Aussie dollar. So just going to look at some examples. Here we can see a push, a pullback, and another push. So there is our bullish market structure. In this piece of price action, we can just draw a box. In this section, we have bullish price action, which is this one. Over here, we can see price moving towards the downside. We can see price pushing down, making a small pullback, pushing down, making a small pullback, pushing down, making a small pullback. So this is a bearish market conditions, and we can see it's characterized by lower highs, and lower lows over there. So those are conditions that we identify. Over here we can see a very good example of just ranging. You can see that price is just moving sideways. It's not creating new high highs or new lower lows or higher lows. You can see that in this section price is just moving sideways. You can see it's not breaking above this region, but it's not breaking below this region. So this is typically characteristics of a ranging market. So that is something that you should by now understand and see. So a few things that we can now point out with regarding market structure is that there's liquidity surrounding these areas. If we look at market structure, we have it over here. There's liquidity below lows. There's liquidity above highs, previous highs. There's liquidity above the highs. There's liquidity above the lows. On this side as well. And there's liquidity above the lower highs. And there's liquidity below the lower lows. How do we know this, and how do we identify it, and how can we make use of it? So let's first look at a bearish example. We know that we take short positions from the lower highs. So typically you would be taking a short position over there with a stop loss, doesn't matter, and take profit below. So this is the move that you would want to capitalize on. You want to take a short from the high towards the low. Now, if you do this, there's going to be millions of other people that do it as well. And they're going to take the next lower high, they're going to take a short over there. And they're going to take the next lower high, and they're going to take a short over there. So tell me, in this case, where is all the stop losses? Even if they went break even or just kept the stop loss above structure, where's all the stop losses? Well, it's obvious. Stop losses just above the previous market structure. So in this area, we have stop losses. So we can point this out by putting a line, and I made a preset liquidity, meaning that above these highs, above this trend line, there is liquidity. What does that mean for me? It means the price is most likely going to sweep or pull into that liquidity. Now, it could look something like this. We can see price creating a low, and then price pushes up, breaks the previous lower high, because there's liquidity. We can see this line, there's liquidity, makes a pullback, and we can now potentially see the trend reversal, and then pushes up again. What creates the space or the volume for price to push up and into this area is because there's liquidity above all these areas. So price will be targeting and will be attracted to each of these areas. As we move up, price will be attracted towards those areas and move up higher. It will give volume, it will give speed, it will give momentum towards the price moving in the opposite direction. If you also remember my entry videos and patterns that I shared, this is a typical pattern that we look at, but that is for a later video as well. But this is just a basic concept of trend line liquidity. Now, the next thing that we want to look at is old highs and old lows. So let's just move a bit the canvas. So where do we have price moving towards the downside? In this area, we have liquidity at different certain points as well. We have liquidity at previous highs, and we have liquidity at previous lows. So where's our lows? Those are areas where we have liquidity. Why is that? Because, simply put, people will take long. They will take a long position. Where will the stop loss be? Well, just below the structure. And they will take potentially another long in this area. So where's the liquidity? It's resting below this low. So I can identify that below previous lows, there's liquidity. And that's why we often see a sweep. Often we see the liquidity below this low, price will dip into it, and if the liquidity was enough, if there's enough liquidity and enough orders there, price will push up higher. Let's push up higher, breaking, seeking the previous liquidity. So now we can see that the bullish liquidity is more important than the bearish liquidity, because if you have to think logically about it, if we have liquidity down here, so let's just type it out, liquidity 1. So we have liquidity down here, and price pushes into it. But we also have liquidity above here that attracts. So if liquidity 2 is stronger and more in control, price will seek it harder than failing to reach it. If the overall momentum is bearish, and we know that the overall direction is bearish, and we're not moving up higher, we're staying bearish and we're moving towards the downside, then we will continue to seek liquidity 1. We will continue seeking liquidity 1, which is to the downside. We will continue to seek that liquidity and move towards the downside. But if the momentum, the order flow shifts, we will continue to seek liquidity 2, which is above. So then price can seek the liquidity 2, pull back towards liquidity 1, just to really capitalize on the orders. So let's just put that there. And then we seek liquidity 2. And then from there on, we shifted our direction, and we're now seeking liquidity 2 more than liquidity 1. So we still return to liquidity 1, but you understand how price has now shifted towards the upside, from a bearish direction towards a bullish direction, because remember, there's always liquidity above all highs and all lows, and that is what moves the market. If you see price moving like this, there's 1,000 different ways of why price can move that way, but just how I understand it and how I trade it is knowing that there's liquidity above those highs. There's liquidity above this high, liquidity above that high, and price is drawn towards that liquidity. And if the bullish liquidity is in control, liquidity 2 is in control, there's more liquidity towards the upside, then price will move higher. If it's toward more liquidity towards the downside, because now we can see that potentially we have a beautiful old low here, price can be drawn towards this area. This can be on a 4-hour time frame. You could potentially see that, let's draw this out so that you really understand. You could potentially see price created a order block or something in this area. That's more on that in the next video. So there we have potentially order block. Where's liquidity? Liquidity is above. There's liquidity 2, above. We create a new liquidity 2, but then all of a sudden price has shifted, and we can see maybe a shift on the lower time frame in this area. Where is our targets? Liquidity 1. Almost always from liquidity to liquidity. Liquidity 1 to liquidity 2. Liquidity 2 to liquidity 1. Always. Then we can see price potentially giving us an entry in this area, and then move all the way towards the downside, towards liquidity 1. So that's how we look at market structure, bullish turning potentially into bearish. Now, let's say you missed this, or it's not in your trading plan to get in there. Where do you then take an entry? Well, we're obviously going to create a new liquidity 2 point, which is then obviously a new lower high. That potentially, liquidity 2, or as in the previous example, a lower high, is now here. So you're going to look for entries in this area, potentially seeking the new liquidity 1 over here. So can you see how, remember our examples of bearish and bullish, how we examine it and we use it in looking at market structure and liquidity. So some of the things that we look at for liquidity is order blocks, which is this area. This is just an introduction to the next video, but I'll just quickly put that out there. So for liquidity, we look at order blocks, OBs. We look at previous highs and lows, which is liquidity 1s and liquidity 2s. And then the last one is imbalances, IMB, imbalance. That is for the next video, so don't worry too much about that, but that is something we will look at in the next video. So I hope you understand and have a better understanding of how market structure is liquidity and how market moves in the direction of liquidity. Let's have a look at some examples on the chart. Let's just quickly get a clean chart quickly. Okay, here we have a chart. Let's just clean this up. On GU, the 1 hour time frame. So first of all, we have a market condition where we make a high, low, a high. We make looks like we're making a lower low, then we make a high, and then we continue the trend towards the upside. Now we're just going to look at this and see how we can identify liquidity. So we created a low. What's below the low? Liquidity. We seek the liquidity, we grab the liquidity. Where's the next liquidity? Above the previous highs, old highs. There's the new liquidity. So just by looking at this example, there were 2 great trades in this area. So we have liquidity 1 in here. Where's the text? So we have liquidity 1 and we have liquidity 2. Liquidity 2. So we know there's liquidity above the lows and we know there's liquidity above the highs. So when we're at liquidity 2, we know we will be looking for liquidity 1. We'll be seeking liquidity 1. There's liquidity 1. So we can expect price, when we're in this area, we can expect price to potentially reject this area by any means. That's more on the lower time frame case studies and entries, but respect that area and then move down. Where will we take profits? Where will we seek price? Where we want to see price seeking for? Liquidity 1. Once we're at liquidity 1 and we rejected this area and we back up into this area, where's the new liquidity? Liquidity above liquidity 2. Remember the previous diagram? Exactly the same thing. And well, obviously we saw down our side it's playing out, but this concept remains the same. In this area, now let's just quickly move to the 50-minute. Same thing. Where's the liquidity? Remember the example of the structure shifting towards the upside or downside? We have the same thing happening here. We have liquidity 1, we have liquidity 2, the lows, but we also have liquidity 2. Liquidity 2 in this instance gets the upper hand. It wins. So we have an entry, possibly. We see price sweeping the lows, grabbing the liquidity at liquidity 1, and then pushes up, grabs the liquidity on 2. Then it pushes down, creates liquidity 1, pushes up, grabs liquidity 2, pushes down for liquidity 1, and then moves up higher. There we can see the shift happening. So we were trading towards the downside, and now we're reaching a higher time frame liquidity area. Because we're reaching a higher time frame liquidity area, remember everything below this line is a higher time frame liquidity area. There's liquidity, there's orders sitting below that low because there's stop losses. Breakout traders will take breakout trades short, so there's sell stops, buy stops, stop losses, you name it, they're all underneath that area. And that is then where we want to see the shift happening. We want to see order flow shift towards the bullish side so that we have confirmation that once we see this happening, we see the shift happening, we can then take a trade anywhere in here. For instance, here we have on the 15-minute, we have potentially a order block. We saw liquidity 2 being reached for, we create liquidity 1, so potentially we will now search for a new liquidity 2. We know that the higher time frame liquidity 2 is above that line, and we can then place our entry in here, our stop loss below the structure, and our take profit at liquidity 2, because we're always seeking liquidity. And that obviously is a very good example, textbook example. But the main ideas that I just want you to realize is that we have higher time frame liquidity, the structure, on the 1 hour, and then we can drop to the 15 minutes, 5 minutes, and see the exact same thing happening on the lower time frames. And that is then how we identify, get our orders, get our entries, and take the trades. So this is just a very broad, quick explanation of liquidity and market structure. Yes. So if you stay till the end, this is very good. This is going to be the giveaway video. So make sure to, a few things, like the video, subscribe, and share it. Please. And tag someone in it. Comment or something. But the most important thing is like it and subscribe. Guys, the winner will be chosen randomly in about 2 weeks' time. And then, yes, you will get free access, lifetime access to the community and everything in it. So, and every future update and so on. So I'm still thinking on how long I will keep this open, but potentially you will have to be subscribed, liked, and comment, because I will use a comment generator thingy thing to pick the winner randomly. So comment what you liked about this video. Yes, so thank you very much. Hope you all have a wonderful day, wonderful weekend, and see you all in the next one. Goodbye.